Hi, everyone. This is the last section of this particular topic, which is Ind AS 1. So what we would now like to talk about, of course, the key differences between Ind AS and AS, right? And also briefly talking about, since the very origin of Ind AS comes through IFRS. So briefly understanding the meaning of, for example, what is a carve out, or I mean, what is that? The reason of the differentiation is something which is the carve out. So that explanation is also provided as a part of this particular discussion, right? So if you look at the key differences, primarily you would like to appreciate that Ind AS are presumably comprehensive, more inclusive. They talk more details, and they try to give a larger, or a detailed information or an explanation of concepts, right? So there are multiple clarifications or explanations given under Ind AS, which is not necessarily available in the AS framework. So in that context, AS or AS1, the presentation of financial statements under the previous GAAP reporting that we had studied, you would see that the AS would probably have more room for uncertainty or ambiguity, but there are more clarifications provided under Ind AS framework, right? For example, there is an explicit statement of compliance required to be made by an entity, right? And also, you may deviate from a standard if you believe as management that if you were to comply with the Ind AS, for example, or that standard could be misleading, okay? And although, of course, we discussed that this could be a rare event, but then just in case the management has a strong reason to believe, it's a genuine reason to believe that this is what it is, so they are allowed to move away from the requirements of the Ind AS, in that context, right? The other important distinction is on the face of the balance sheet, right? The entities need to distinguish between the liabilities and the assets, between the current ones and the non-current ones. All right. So the order of liquidity is also there, what we discussed in the initial coverage of balance sheet, but predominantly it is the current and non-current classification of both assets and liabilities which is required. Ind AS specifically prohibit the use of extraordinary item as a phrase. So this term is absent, practically missing from Ind AS perspective. Although in the AS there was a place where you could actually quote it, that some event which takes place, which is unexpected to arise, and which is a significant event, right? Not happening in the normal course of business. So you could actually show that as a part of your statement of profit or loss, or the profit and loss account in the earlier frame, which is absolutely prohibited under the Ind AS framework. Okay. Also, the disclosure is required to be made by the management in respect to the judgments made by them. So it's a little more deliberated effort under Ind AS, although the similar disclosures were also required under the AS regime, but it's more specifically requires disclosures of key assumptions and the source of measurement of uncertainty causing significant risks, right? Or causing material adjustment. The risk of causing material adjustment, if it is significant, then that also needs to be disclosed, which was not very clearly identified under the AS1 perspective there. Okay. The other set of differences, specifically under Ind AS 1, you need to present your expenses on the basis of nature. It's a normal presentation of the statement of profit or loss. The kind of structure that we saw, that's something which is categorically identified or defined as presentation under nature, nature method. Okay. Also, there's a requirement under Ind AS to present the balance sheets and the other set of financial statements on a comparative basis. This was also the case, by the way, under the AS1 perspective. However, in case there is a change in accounting policy or a retrospective adjustment to be made, then the relevance of a third balance sheet is something which is emphasized upon under the Ind AS, perspective. All right. Again, the other part is, in case there's a reclassification, the Ind AS 1 actually requires the disclosure of that nature or the amount, and also the reason of such reclassification, right? So just to adhere to the consistency principle. So that's where this disclosure is very clearly identified, which is not clearly mentioned under the the AS framework. All right. The other set of changes that you observe is there is a specific need of SOCIE, which was never in place under the AS framework. All right. Similarly, you have other comprehensive income, the below the line portion, right? So which was not there under the AS1, where we only used to prepare a P&L account or profit or loss account. So here we have the component of both profit or loss and also other comprehensive income as a part of the same same statement, which is statement of profit or loss. And finally, another key difference that you look at is the classification of a long-term arrangement. In case it is there is a breach and somewhere the agreement has been obtained between the borrower and the lender that the demand for that particular loan would not be made, right? So in those cases, again, you may continue to classify that loan as a long-term loan, right? It does not have to be qualified as a current item any which ways. Again, this was not clearly mentioned under the AS framework, right? Now, of course, as we discussed originally, that when you have the Ind AS, which is essentially originating from the IFRSs or the global standards context. So broadly, the idea of the Ind AS is to keep them in line to the extent possible with the respective or the corresponding international accounting standard or IFRSs, and where very strictly where you believe that the differentiation or a change has to be, or a deviation has to be made, right? A departure has to be made from the original standard, right? That's where the carve out comes into the picture. Okay, so essentially, considering the economic environment of the country as compared to the the economic environment as presumed under the IFRS's regime, those differences arising as far as the application of the Ind AS is concerned, and that's where the word carve out is used. All right, but then at the same time, there could be an additional guidance provided, let's say in a very specific scenario of Ind AS 103. That is where the reference of the word carve in comes into the picture, right? Just for understanding purposes. It's not something which is significant from a examinations perspective. So just to highlight that part. All right. Now, what we also want to talk about as a part of Ind AS 1, that so far our discussion has been around standalone financial statements. There was a brief reference of course, when we mentioned about the non-controlling interest in the beginning, and we said that we want to take it in the context of the group accounting, and we shall do that. But briefly, also wanted to bring along that Ind AS 1 is not only applicable to a standalone set of financial statements, it is also applicable in the same manner even for the group financial statements, right? The details about this, the group accounting, the group structures, etc., would be comprehensively dealt with towards the end of these standards when we actually do the group accounting, and there are multiple standards covering this topic. But then just to highlight it again, the way you prepare your financial statements for a single entity or a standalone business, you do the same way, for example, let's say for also the group financial statement. And that is what is quoted here, that is what is mentioned here, is that when a company is required to prepare consolidated financial statements, it shall mutatis mutandis. It's simply that the moment the requirement changes from a standalone to a group financial statement, the same set of financial statements would be prepared, and the Schedule 3 requirements would be, also be applicable as far as the preparation of a balance sheet or a statement of changes in equity or a statement of profit or loss is concerned. We go farther, we talk about, of course, also the disclosures and also the statement of cash flows, right? So that's where we start looking at the group financial statement shall disclose the relevant information, including the profit or loss as attributable to the non-controlling interest and to the owners of the parent, right? I would not want you to be worried about it again here a lot in terms of what these terms would, normally try to indicate. We would be discussing these all comprehensively we would be preparing a lot of, financial statements as well at a group level, right? So you can just try and understand that whatever you're doing at a standalone level, you continue to do it also at the group level. That is something that you're supposed to know. So the profit or loss as attributable to the non-controlling interest and to the owners of the parent has to be presented. Also, the total comprehensive income has to be presented for both the parties, and the disclosure shall also be made in the statement of changes in equity about these so-called as the allocations, made, right? Not just for the total comprehensive income, but also for other comprehensive income, right? It's just about the context there. So we would not be spending a lot of time knowing these things at this stage, but just need to be aware of it, that we are going to hear these terms eventually, right? Where we look at non-controlling interest, we look at parent, we look at investments, we look at subsidiaries, associates, joint ventures, etc. They would all be covered in the discussions when we talk about business combinations or consolidated financial statements, or the overall umbrella of group financial statements. All right. What we want to discuss now is, we want to now deal with a few questions from Ind AS 1 to test our knowledge of the concepts that we have been through so far. Okay. Let's have a look at the first question there. It says that an entity manufactures passengers vehicles. The time between purchase of raw materials and the date of completion and delivery is 11 months of time, and the customer settles the dues after 8 months from the date of sale. The question is, will the inventory and the trade receivables be current in nature? And secondly, assuming that the production time was 15 months, the time lag is, let's say, 13 months, will it change the answer? Okay. Now, if you take a step back, you would recollect that we talked about the meaning of current item, right? We had 4 benchmarks, but then the relevant ones would be here probably 12 months and operating cycle, right? You would not want to forget the higher of 2. Always remember that, okay? So if the entities, if a business's operating cycle is more than 12 months of time, so anything which is getting realized within that operating cycle is a current item, right? As an asset, for example, right? Or anything that needs to be paid within that operating cycle's time is also a current item. Of course, is a liability in that case. However, if the operating cycle itself is less than 12 months, then we take a window of 12 months itself, right? So what I was saying here is that in the given scenario, the time lag is 11 months and then 8 months. That makes it, of course, 19 months of my normal operating cycle, right? So both my inventory and trade receivables would automatically become current in nature straight away, right? And further, if this, for example, changes, right, and the production time is 15 months and it takes another 13 months, which makes it, of course, 28 months, the statement doesn't change because the normal operating cycle has now increased from, let's say, 19 months to 28 months. And any which ways, we look at the higher of 12 months or the normal operating cycle. That's the way we start looking at that particular questions. As we said that the inventory and receivables need to be classified under Ind AS 1, and it would be current if it is recoverable within the normal operating cycle. Okay. In the first scenario, we have the operating cycle of 19 months, as we expect to realize or recover these in the normal course. So that would become a current item. it doesn't really change, even if the cycle itself has changed considerably, right? Till the time you're recovering or realizing the money back in the same time frame, nothing really changes there. All right. Let's have a look at the second question now, right? It says that A has taken a long-term loan from B. In the month of December 19, there has been a breach of material provision of the arrangement, and the loan becomes payable on 31st of March 2020. In the month of May 2020, the company started negotiation with B to not demand payment as a consequence, and the financial statements were approved in the month of June, right? In the month of July, both the companies agreed that the payment will not be demanded immediately. The question is, advise on the classification of the liability as a current or non-current, right? Now, to address these kind of queries, you need to remember the timeline part of it, okay? We are given that somewhere in December, there is a breach. Let's look at the years. It's 19. This is December 19. This is March 20. This is June 20, and this is July 20, right? So there's a breach, and this is the end of reporting period, right? This is the approval of financial statements, and this is the agreement, right? Where you would be, where the lender says, the company B says that it would not be demanding the repayment, okay? Importantly, the breach took place here, and it is appearing current because the money is payable immediately as per the provisions. As per the agreement, the money becomes payable, right? But then the Ind AS 1 also suggests that if that consent was achieved prior to approval of financial statements, then you may continue to call it as a non-current liability. However, the consent was only received after the financial statements were approved for issue, okay? Which actually means that there is practically no possibility. There's no realistic possibility, and the company A is under an obligation to not avoid the repayment, right? Which actually suggests that the liability or the loan has to be shown as current in this particular case, okay? Let's have a look at the formal solution here. It says that where the breach of a material provision arises on or before the end of reporting period, and that makes the liability payable on demand, it is classified as current even if the lender agrees after the reporting period, okay? But the lender agrees to provide a period of grace of at least 12 months, right? Then in that case, it could have become a non-current liability. However, in this scenario, the company B, which is the lender, of course, is only agreeing to not demand the payment after the financial statements had been approved for issuance, right? Which simply means that for the year ended 31st of March 20, the liability would continue to be classified as current, right? That's an important point that you want to consider. From a timelines perspective, we will take you back there. The approval should have come, or the agreement should have happened just before the approval, right? If it is happening a bit later after that, then the classification of the liability would be, done as a current item only. Okay. Let's have a look at this question as well. It says that Mike Limited has undertaken various transactions for the year ended 31st of March 18, and there are a list of items. The question is, identify and present the transactions in the financial statements as per Ind AS 1. Now, this could be a very interesting, important question from an examination perspective. Here, the testing of your knowledge on how do you present your items in the statement of profit or loss, how much goes above the line and how much would go, let's say, for example, below the line, is something that you should be aware of, right? It says remeasurement of defined benefit plans. It's clearly an OCI item. Current service cost is a PL item. Revaluation surplus is an OCI item. Gains and loss arising from translating the monetary assets. Okay, this is a P&L item. On translation of foreign operations, OCI item. Equity at FVOCI is OCI again. Tax expenses is P&L. Share-based payment is also P&L. So if I were to bring this, I would say statement of profit or loss for the year ended 31st of March 18. So we can simply take profit or loss items, right? We have got service cost, okay? Which is 105,000. And then we have monetary items, 45,000, gains and losses. So we don't know whether it's a gain or loss arising from translating monetary items. Let's assume it's a gain. Okay. And then we also had income tax expenses and share-based payment cost. We should rather take the share-based payment cost first, and then the income tax expenses, just to respect the position of these expenses. It's 201 and 21. So let's take it 201 and 21,000, whatever that amount is, right? And then we also have other comprehensive income. All right. We have got now remeasurement of defined benefit plans, changes in revaluation surplus. By the way, these are both not reclassified, right? That's another aspect that we want to remember. As far as the translation is concerned, this is reclassified. So we need to also take care of that. This is also not reclassified. So that's other distinction that we want to make. So we can pick up something which is not reclassified, which is remeasurement of defined benefits, right? Revaluation surplus, right? And then we had also gains and losses of investment in equity instruments, right? So these are amounting to, so we don't know whether these are gains or losses. We don't have a complete information, so we can take it like this: 154,200, 154,200, and then we have 75,000, and then we have 60,000, 75 and right. And then we also have reclassified, which is translation of foreign operations, right? That's amounting to, the only amount left is 39,000, right? Now the problem is that we don't know whether something is a gain or a loss. We don't have an answer on that completely. So maybe we want to just ignore these brackets also, just to ensure that we are not missing on the context there, right? So I think that the important point here to remember here is that you need to know what all comes in your P&L, the profit or loss, and what all comes in the other comprehensive income, within which how much could be, or what amounts would be not reclassified, and what amounts would be, let's say, reclassified there, right? Let's have a look at the formal solution. Of course, the current service costs and translation of monetary assets, tax expenses, share-based payment costs would be all a part of statement of profit or loss. Other comprehensive income would include defined benefits, revaluation surplus, translation of operations, and equity instruments as well, right? You might as well want to look at the total comprehensive income. Of course, the amounts are not given in pluses or minuses, so we don't have a complete information around it. But this segregation of amounts is something which you should be always very, very comfortable with from an examination standpoint. All right. Well, that's it from my side on this case. Thank you very much.